Welcome to the Wakecon show, where we discuss housing economics and the economic forces that are shaping our communities. This is powered by Professor Lending, which is a residential mortgage brokerage based in Wake Forest, North Carolina, hence Wake Econ together. That's cool, isn't it? I'm Jordan Steffaniak, licensed loan originator, president of Professor Lending, and your home buying and home economic professor. In today's episode, I'm going to be covering the topic of should you refinance now or wait? Right now, we're in 2026. The beginning here, it's February 9th as I record this. Depending on when you watch this, it may still be the spring or maybe the summer, but I think this information is going to be relevant no matter when you look at it in 2026, based on my judgment of the economic conditions of the United States of America. So let's sort of walk through a couple of things. And just so you know, for most of these videos that I record for you guys, I also put forth written formats that are simple 1,000 word summaries and explanations of what I'm talking about. So I'll make sure to try to drop the link in the show notes so you can have access to that as well, because sometimes I miss things as I review these things and go over it. So let's go ahead and get started, right? So one of the big questions simply is, at this point right now in our current economic environment where mortgage interest rates are at, does it make sense for me to refinance? Well, it depends on your situation. If you're one of the lucky people who bought or refinanced during the post-COVID era and you have a 2.5% interest rate, you can go ahead and turn off the video now and enjoy yourself in that ultra low mortgage rate that you will never ever see again. We are all envious of you. For the rest of us who are either buying houses now or have, for whatever reason, have a larger mortgage interest rate, if you are basically at anything 6.5% or more, the answer is probably yes. You should refinance now. Now, obviously, it depends on your credit profile. It depends on a lot of factors. So you want to get a quote from a licensed loan originator based on your scenario to understand what's actually available to you. This is not an endorsement. This is not a license to tell you exactly what you're going to get. I don't know that without talking to you and having your information and taking a full loan application. With that sort of caveat in mind, you do know that given the current time, compared to this time last year, February 2026 to February 2025, on average, we're about at a full percentage point better on the interest rate on mortgages. So if you take a 30-year fixed conventional mortgage, it was about 7% this time last year. Now we're at about 6% this year. That's awesome. That means that there are definite refinance opportunities. VA is even better than that. So let's walk through when you should refinance, when you shouldn't, and what sort of things you want to take into consideration. So let's go ahead and just start with, where's that threshold of I should go ahead and refinance now? My opinion is that if you can break even on a refinance within 12 months or less, it's a no-brainer decision. You do it every time. So let me just take an example. I'm going to throw this on the screen here so you can take a look at the numbers. And again, these are just examples here. So I'm taking an example of, let's say you bought a house in June 2024. So a year and a half ago, depending on when you're watching this, right? And you have $300,000 left on your loan balance. Let's say that your last interest rate was 6.875 and your new one is 5.99. How much are you going to save? Well, you're going to save about $200 a month in this scenario. It's going to take you about 10 months to recoup that value. And now that is an estimate. So what do you think? Like, what's recouping the value? What are you paying for? Well, you're paying for closing attorney fees. You're paying for any lender fees that a lender might charge. Maybe it's an origination fee, a admin fee, an underwriting fee, whatever it might be. Might charge that. This could range from $1,500 to $4,000 to $5,000. I don't know your particular scenario. I don't know which lender you're working with. Could be anything in there. I'm just assuming $2,000 for the sake of comparison here. Could be an appraisal fee, might not be. I don't know. All that impacts that bottom line. But let's say if it's $2,000 and you're saving $200 a month, you're breaking even in 10 months. Simple. And then after that 10 months, you're just saving $200 every single month through the rest of the life of that loan. That to me is a no-brainer. You go ahead and do it. And that number isn't even including something like mortgage insurance. So let's say you pay $150 a month for mortgage insurance and you've paid your principal balance down substantially, or your home might appraise for even greater value. There's a good chance that you could save not only money on your interest rate, but saving it by getting rid of mortgage insurance. So really, the moral of the story, in my opinion, is if you can save or break even essentially in 12 months or less, it's a no-brainer. If you can break even in 24 months or less, it's probably, yeah, you should still do it. If it's greater than 24 months, typically I say, well, let's think about your financial situation. Let's think about your goals, where you're going in the future. Because if you're saving in 24 months or less, breaking even, usually there's no scenario where you're going to lose out on that. You'd only lose out on that if interest rates suddenly dropped at an entire percentage point within 6 months. Very unlikely, and we'll cover that briefly here momentarily. Or if you had to move. Now, it's not the worst end of the world, if you break even at 12 months and you moved at 10 months, like, okay, you broke even, right? It's about that way. So, when you think through these situations, I also want you to think in increments of 3, 5, 7, and 10 years. A lot of people think, hey, my mortgage is 30 years. I think it in terms of the 30-year mortgage. Don't think shorter terms, because most people are in the loan 5 to 7 years because they're moving or because they are refinancing for some reason. So, if you could save money to where you're breaking even in 12 months or less, absolutely do it. If you're saving money and breaking even after 24 months, you should probably still do it. If it's greater than that, you need to talk to a mortgage professional and get an understanding of what makes the most sense for you. And that's the case for all of this. You should always talk to a mortgage professional who has your best interest in mind, who isn't trying to sell you something, who's not a snake oil salesman, who's not trying to hoodwink you into just doing a financial transaction that's not going to actually benefit you. Talk to somebody who actually cares about you and wants you to get the best possible financial deal for you to save you the most money, to allow you to do what you need to do to take care of your family and your future and everything. Talk to somebody like that. I'm happy to help if I'm licensed in your state, or I can recommend somebody who is licensed in your state to help you, to walk through what are the options, when does it make sense for me to refinance, when does it make sense to sort of pull that trigger. Now, one of the objections you hear oftentimes is people who think they can time the market. They think, well, interest rates are going to drop further. I heard this question again just a couple weeks ago. They could save $350 a month right now, but they want to wait and see. Well, why wouldn't somebody do that? Well, why would someone do that? Well, they think, okay, interest rates are 6 now. I bet you they're going to be 5.5 or 5. And I don't want to pay that money up front and then sort of get a higher interest rate. Well, you can always refinance again. And the second piece is you have no idea if interest rates are actually going to go low or much lower. They may stay the same. They may go higher, or they may go down a little bit. But if we went from 5.99 to 5.75, you're not going to see benefit from that by waiting. Let's say even if they went down a whole half point from 5.99 to 5.49. Let's go back to our previous scenario. You're going to save in that scenario at that $300,000 loan amount about $118 extra a month. But it's going to take you, there's my calculator. So let's take that 12 months as an example. Over that 12-month period, you had lost out on $2,400 in that other scenario, right? Because you kept your higher interest rate and you kept paying additional. So $2,400. Now let's divide it by the $118 a month extra you're saving. You'd have to save for an extra additional 20 months once you refinance to break even with that other person who refinanced right away. That's almost 2 years. And then you're only saving $118 a month more than the other person. And maybe by year 3, you've moved, or year 4, you have a different financial situation and you need to refinance again for a different reason. Maybe rates went higher. Maybe rates didn't change at all to where you're not actually saving. All that to say is, look, guys, you're playing the lottery if you try to wait it out. The best scenario is let's refinance now when it already makes financial benefit for me, financial sense for me. If I'm saving $200 a month and I'm going to break even in less than 12 months, obviously I'm going to do it. If interest rates continue to go down, you refinance again. That, by and large, is the best financial advice that you can get to save the most money and keep the most money in your pocket. If you only want to do it one time, for whatever reason I don't understand, you don't want to save the most money. If you want to save less money, then go ahead and try to time the market. Maybe you'll be successful, or maybe you'll end up paying an extra $10,000 compared to person A who decided to refinance right away. So my suggestion is talk to a mortgage professional, understand your situation, and if you're saving money and breaking even within 12 months or 24 months, you should refinance. If it's greater than that, then hey, let's go ahead and have a discussion about what it might look like. But you're going to lose out oftentimes on a lot of this. People try to time stuff and it never really works out. But I mentioned what if rates don't go down a lot? And I said, I don't think they're going to go down a lot. Why do I think that? Well, I think we've probably honestly already found our floor, the lowest floor when we went under 6% on average for the mortgage interest rate earlier this year in 2026 in January. And that happened after President Trump announced they were going to put $200 billion to buy MBS, mortgage-backed securities. Immediately, mortgage rates improved. And then there was other economic data that comes out that makes it not improve. I tend to think our floor, probably on average, is 5.75. That's the absolute lowest we're going to go because it doesn't matter who the Federal Reserve Chairman is. It doesn't matter who the president is of the United States. They cannot control mortgage rates. The Fed does not control mortgage rates. They have a large, substantial influence on it. But even so, the Fed has a board of governors who has to vote on where the federal funds rate is going to be. So even though number one, it doesn't have a direct correlation to mortgage rates where it goes up, mortgage rates go up, it goes down, mortgage rates go down. That doesn't necessarily work that way. It's all being based on actual economic data in the market. So if the Fed cuts rates and the economic data gets better, then you're going to see mortgage rates go up, even though the Fed cut rates. That's just how it works. Okay. But also, if you look at the dot plot, now the dot plot's for the nerds who care about the Federal Reserve and care about their meetings and care about all their stuff. The last dot plot came out in December 2025 from when I'm recording this. And all the dot plot is, I'll try to show it here for you, put it on the screen. See all these dots? All this is every board member of the Federal Reserve is saying, look, here's where I think the interest rates are going to be at this period, 2025, 2026, 2027, 2028, and the longer run. So as you can see at the end of 2025, everybody's in that 3.5 to 4 window. And you can see that it does go down a little bit, but even in the longer run, 4+ years from now, you're still in the 3 to 3.5 window. That's not a substantial drop. You're not talking post-COVID where it's down in the under 1 category, when you're receiving mortgage rates at these 3% or below range. Not happening. Even with Kevin Warsh, and number one, remember Kevin Warsh, the new chairman, he used to be a fiscal hawk on these things, and now, maybe he has a dovish tone to himself because he wants to please President Trump, because you have to, I guess, in today's scenario in order to survive without being accused of things. But whatever you think of all that, even if he's bent toward, hey, I want to have your ear, he still has to get all the board of governors to say, yes, let's do this. And even then, even with the sort of dovish nature of certain members there, you're still not seeing anything below 2.5. Only one person in 2026 has below 2.5. Only one person in 2027 has below 2.5. 2028 in the long run, none. Zero. So the reality is, considering all the economic factors, plus how the Federal Reserve sees the outlook of the future, I don't see mortgage interest rates getting substantially better. They're already better, a lot better than they were last year. But I don't think they're going to get all that much better. So if you're trying to time the market, you're probably going to lose out on savings. You're probably going to lose out on $500, $1,000, $2,000, $3,000, $4,000. So why wouldn't you lock in, cash in right now, save the money now, and then wait and see what happens? Maybe refinance in 6 months, another year. Cool. It's not that difficult. I have no conceptual understanding for the person who says, I don't want to refinance until I save $600 a year. That makes zero sense to me. So you're telling me that you would be fine waiting for 4 years. Let's say you save $400 a month right now. You don't want to do it till you save $600. Let's say you don't save that $600 for 3 years. $400 a month over 3 years is $14,400. So you're saying that money doesn't matter to you because you want to wait until you could save then $600? No, that doesn't make sense. That doesn't make financial sense. You're losing substantial sums of money by doing that. You should talk to a mortgage professional about your situation, though. Everybody's is unique. It's all based on, credit profile, the house profile, like all these things matter. Where you live, all that matters into understanding what makes financial sense for you, what's financially available to you. So talk to a mortgage professional. But what I'll tell you is it probably makes sense to refinance right now for you. But you don't know that until you talk to somebody. I'd be happy to help you and walk you through the questions and the scenarios for you. Zero obligation, not salesy. I'm just here to help you. Like, I like helping people. I like the whole process. I talk to people all the time. I just like doing this. It's fun. I enjoy saving people money. I enjoy strategizing with them and helping them to understand their whole financial picture and what it's going to look like in 3, 5, 10 years, what decisions they should make to help set themselves up for success and for generational wealth. Home ownership is that key ingredient for generational wealth. For the average everyday American, this is how you build generational wealth. You have a house, and then you leverage that house. The concept of financial leverage doesn't make sense to most people. Okay. I'm not going to go into a whole spiel of why you should buy a house right now. I could, and maybe I would. But the point of this whole video is just to tell you that in 2026, it probably makes sense to refinance sooner rather than later. But you should talk to a financial professional, mortgage professional, to understand your specific scenario. So if you have questions, thoughts, ideas, drop a comment. You can go check me out at professorlending.com. You can email me there, do whatever you need to do. I'd love to chat with you, love to talk to you about your own scenario, find out what makes sense for you. Anyway, I appreciate you for tuning in. And this is another episode of Professor Lending. I try to do a lot of these that just give you resources, short 10, 15-minute clips talking about different housing economic pieces that can help equip you. Because I think the more education you have, the more empowered you are to both benefit your own family, but benefit your community to grow, to become more financially stable and everything like that. So look forward to thinking with you guys soon.